You probably heard that the best investment strategy is just to throw your money into the index funds and let it grow it until you are retired, and with the average growth of the 8 or 10% annually. With the power of the compounding, you will be doing great by the time you retire. But no one really talks about how to do that, how to invest in S&P 500, what stocks you have to buy to do that. So here in this video we will answer these questions. Before we figure out how to invest in the Vanguard index funds or S&P 500, we have to understand the few key concepts that is ETF. How do manual funds work? And what kind of the ETFs you have to buy to get the average rate of the 8% annually. ETF, the greatest financial innovations. The ETF or an exchange trade fund is the security that includes within itself the multiple other securities such as stocks, bonds, real estate. It's basically a financial management company that take investors' money and invest them in the certain types of the assets, but at the same time their stocks are traded in the stock market like any other publicly traded company. It's a great way to diversify your investment portfolio. ETFs usually track the particular index. The most famous ETF you probably heard about is the one that tracks S&P 500. S&P 500 is the stocks market index that measures the stock's performance of the 500 largest companies listed in the stock exchange in the United States. There are around 3,700 publicly traded companies in the US alone. So, as the investors, you have the pretty big choices. However, it's not easy to analyze so many companies and find out what are the best and at the same time the safest investments. That's where S&P 500 comes into the picture. It filters the best and safest stocks out of the basket. They are the certain criteria that company needs to be met in the order to join the S&P 500, such as the company should have at least $8.2 billion of the market capitalization, most of its shares, and should be in the public hands. The company should be in the stocks market for at least a year and many other criteria. Even the company like Tesla with over $300 billion valuations couldn't join the index, but that doesn't mean that every company in the index funds is going to great in the long run. But since they are largest 500 companies in the country, most of them in the long run are going to grow at different rates and judging by the historical data. Since inceptions in the 1926, it has been growing approximately at 9.8% annually or 6% after inflations. However, there are several years where the index declined in over 30% during crisis. The 10 largest S&P 500 companies account for the 26% of the index companies, such as Apple, Microsoft, Berkshire, Alphabet, Johnson Johnson, and a few others, Amazon, Visa, Incorporations, Poker, Gambling, JP Morgan Chase, Facebooks. If you realize that at least half of them that are tech companies, so if they suddenly rise for the reasons or another, they will have massive influence over the market to drag with them the rest of the market. But on the other side, if they fall, the entire market could be down just because tech companies aren't going great. Second, manual funds. Let's let the experts manage your money. Manual funds is similar in many ways to ETF, but functional is the slightly different way. Instead of the passively investing in the certain index or the industry, managers at the manual funds strive to beat the market but at least a small margin. So before picking a company, they would analyze their financial statements and try to invest only in the companies they believe would do the best. Investing in the manual funds is like the hiring a bunch of the financial experts who will choose where to invest your money in. But that doesn't come to the cheap price. Manual funds usually charge the percentage of their hard work to manage your money, which is typically between 0.5% to 0.75%. Anything higher than that most probably doesn't worth it. 1% might not seem like a lot of the money if you are investing the $1,000, but if your portfolio is around $1,000,000, then that's at least a $10,000 difference. If that's the case, why would anyone invest in the mutual funds? Well, you see, when you have the huge portfolio, let's say the $100 million beating the market, even by the small margin, like 1%, a lot of money, because that will equal to $1 million, enough to provide you with the luxurious life for the entire year. Imagine if they beat the market by the 2 or 3%, the difference would be massive. Third, Vanguard. A convenient way to invest. So the question is where to find the ETFs or the mutual funds to invest in, and that's where Vanguard comes into the picture. Vanguard Group is the financial management company that has multiple ETFs and the mutual funds under their wing, with about 6.2 trillion in the global assets under management. They have ETFs that invest in the bonds or different industries or mega cap indexes, such as the companies to have market capitalizations of over $200 billion, like MGS mega cap ETF. And you can scroll down through their websites and find out the right ETF for the or the mutual fund for you. The famous ETF that invents in the top 500 US companies is VOO, or S&P 500 ETF, that's currently traded around $313 at the time of the script. Its asset worth almost $596 billion, with its top 10 investments representing 30% of its assets, since most of them are tech companies such as the Facebook, Amazon, Apple, and so on, which also makes it the slightly risky investments in the short run. That's why Vanguard puts it at level 4 risk. Tech companies are quite volatile, which means they quite often either significantly rise as they are going to dramatically drop. So if you are the more short-term investors, then it's probably not be the best options for you. It makes more sense if you are looking for the 10 years or more. By the way, it has the expense ratio, but it's really low, 0.03%. That's insignificant. This particular ETF was created back in 2010, and since its inception, it had the average rate of the return 14.7%. That's incredibly high, but you have to take into account that at the last 10 years were the longest period of the economic expansions in the history of the US, and tech companies that make up to 30% of its portfolio skyrocket in the last year. That's why it doesn't mean it's going to have the same rate of return for the next 10 years, since if the ETF was created 3 years earlier, back in 2007, numbers were completely different, because in 2008 we had a financial crisis. The S&P 500 was down by almost 50%, and final crisis happens every now and then. Another ETF worth talking note is VTI, or Total Stock Market ETF. It's a huge, with assets reaching almost $1 trillion. Maybe because it was created back in 2001, so it has been around for almost 20 years. That's why it can give us the more secure rate of return, which has been historically 7.8%. But Vanguard isn't the only financial management services company that provides such services. The market is filled with them. 5W0 Total Market Index Funds. It's an ETF that provided the fidelity investments. That's also invest in the S&P 500 or Power Shares QQQ by investing capital management. There are just so many of them that we can cover them in this video. The question that most of you are wondering about: how can I buy the Vanguard ETF stocks? To invest in one of these ETFs, all you need is a broker. If you are in the US, you probably heard about Robinhood, for example. This video is not sponsored by them, but because they are the commission free, it makes it easier for many to start. But they aren't the only. But you can use any other brokers. But if you are not in the US, it doesn't matter. You can invest in this ETF throughout almost any brokers in your city. You just have to find one. If you take a look at S&P 500 rates of the return for the last 90 years, it has been 9.8%. That doesn't mean it's going to be like that forever, but 90 years is the long enough period to assume that it will be around that number for the next few decades or so. If you have full-time job or the business, it doesn't make sense you to sit down and analyze stocks every single day and find good investments. You might not even know how to do that. That's what makes ETFs so attractive. Is the convenient way to invest, but before you throw your money into any of these index funds, be sure to read more about them because you are risking your money. Don't base your decisions solely on the couple of the videos you watch on the YouTube, but rather understand the market. And most importantly, make sure to give this video a thumbs up if you have enjoyed and found it helpful, most importantly. And if you are the new around here and want to know more about investing, then make sure you subscribe and turn on your notifications. Thanks for watching, and until next time.